Right, I think we're beginning. Hi, my name is Richard Perry. I am the market analyst at Hantech Markets. Welcome to my webinar that I'm hosting today on the RSI. I'm going to give you some bit of theory, some ideas as to how best to use the RSI for your trading signal. So hopefully it's going to be useful for you. First of all, I'm going to show you my disclaimer as I think I'm going to be talking about live market information. So therefore, I think we need to just make sure that you've read and just understood everything about the disclaimer and what it's for, because it is a regulatory requirement. So that's that. And then just a little bit about myself. Just very briefly, I've been in the market for 13 years. I have traded technical analysis for all that time, and I've also got qualifications, STA diploma, got a distinction on that. So hopefully that gives me enough knowledge to be able to just give you this webinar today, and hopefully you can understand that I am fully qualified to do so, and I hope you find it useful. So a little bit of an agenda now. Everyone's got an agenda, and this is mine, and this is starting with a little bit of theory behind the RSI, and a few basics, bit of calculation, how best to read it, more to the point, and then I'm going to move on to the different uses of the RSI, specifically focusing on trading in trending markets, and also range-bound markets, because it's two different scenarios where you use the RSI and you get different signals from that. And then finally, a few trading signals, the crossovers, divergences, and failure swings are the classic ones. And then I'm going to finish up with a look at how the current state of the markets are at the moment, just bringing in a few other trading indicators as well. Throughout the whole webinar, you have got the ability certainly to ask me questions, and certainly if it's relevant to what I'm talking about as at the time, then I will certainly use that question and focus on it. But if it's more of a general question, then please just bear with me. I will focus on it towards the end when I'm looking at other markets and just bringing everything together for you. So just if you don't get your question answered at that time, please just bear with me, and I will get to it in the end. Furthermore, if I don't actually get to it at all, it might be due to time constraints or whatever, then you can always email me, and I will get back to you in due course. I'll give you the details to that at the end of the webinar. Okay, so first of all, the basics of the RSI is as with momentum indicators generally, is that what goes up must come down. And it's the concept that basically nothing goes in a single direction forever without some sort of correction, some sort of retracement in the price. If that's going up, then you'll get the profit takers being tempted to come in and just take money off the table. If, for example, that is there's a sell-off, you'll eventually get bargain hunters coming in and buying. So there's always a change of direction that should happen at some stage, and I think the RSI is one of those indicators that depicts that in a very good and positive way, a very useful way. It was devised by Wells Wilder in 1978, and he came up with this calculation, this formulae that I've got on this slide here. There's no real need for you to know or really understand exactly how it works, but it's on the premise that basically you look at the number of positive closes versus the number of negative closes across a range of periods, basically, and it just looks at the magnitude of the recent gains versus the magnitude of recent losses, and effectively the greater the number of positive closes in the range, the higher the RSI will be. And alternatively, if there's a greater number of negative closes, then the RSI will be a lot lower. So it sort of gives you a gauge of exactly where the price is in terms of its current range. It is one of the most popular momentum indicators that you get, and a lot of traders will follow it. And you'll hear, certainly if you ever watch me on CNBC or read any of my stuff, then you will hear me talk about the RSI a lot. It is one of my favorite indicators, certainly, and I think it's very useful for a lot of trading signals. It oscillates between 0 and 100, and therefore you do get extended levels, and as per the original Wells Wilder theory, above 70 is basically where he found that prices were becoming overbought, and below 30 is basically where prices are becoming oversold. So subsequently, 50 is your midpoint line in the RSI. Liquidity is an issue. You could argue, certainly, the more liquid the instrument you're trading, the lower level it takes for it to become overbought. Say, for example, you're trading on euro dollar, the volume obviously on euro dollar is significant, and is the most widely traded forex pair out there. So the moves on the RSI will tend to not reach, or tend to only just reach 70 and 30. So you compare that to, say, like something that's far less liquid, say, for example, in indices, maybe you're trading the FTSE MIB, the Italian FTSE MIB, or the Russian MISEX. Maybe they are far more volatile, and therefore you see sharper movements in the RSI. The extreme example I'll probably give you is trading on the AIM market in the UK here. It's the AIM stocks will go consistently into overbought territory and oversold territory, and it's not such a good indicator, the RSI, in that case. You can change your time horizons on the RSI. The classic use of the RSI was using 14 trading days or trading periods. You can shorten that period or lengthen it. Shortening it to, say, for example, 9 periods or 9 days RSI would increase the volatility, but you get swings and roundabouts with that. You get more trading signals, which is, I suppose, if you're a shorter term trader, that's good for you, but you equally get more choppy moves, more false signals. So it's sort of 6 of one, half dozen of the other. So you need to make sure that you've done your research and looked into how best to use the RSI. Equally, in a longer term basis, maybe you're an equities trader, you would be looking at, you can extend the RSI to maybe 14 is the classic, but maybe 21 is more of an idea there that you could use, as it gives you just more of a smoothing impact on the chart. Now, we have our first chart, which is just a comparison of all those RSIs as I was talking about. On this chart here, you've got 14 in the blue, green is 9, 21 is the red. And you'll see that 21 gives you a lot less signals. You tend to go only just touching the 70 on, this is on euro dollar, so again highly liquid trading, but that time, that back in October 2013, when it only just hit 70, the 9-day RSI was up at 80, and the 14-day RSI was peaking over 75. So you can get a gauge of how the RSI on the 9-day will go a lot more overbought very quickly, and potentially give you more signals, yes, but equally you can get some false signals as well. So just bear in mind what you're trading and what your trading mentality is, and your outlook on your trading periods are. So you can use 14, 9 or 21, but even equally you can use anything you really want, as long as, I would stress again, as long as you've done your research and you've seen exactly what works best for you. Okay, so now moving into different markets. Now, as I said, the 50 line is an important line on the market, on the RSI. Above 50 suggests that the gains are greater than the losses, and below 50, the losses are greater than the gains. But with the 30 and the 70 line, it sort of depends on which market you're trading as to how to use these lines. as I've shown you here, there are different markets you can use the RSI for. In a trending market, you've obviously got uptrends and downtrends. So you look at the RSI in a different way. In a strongly trending up, strongly uptrending market, you'll see that just purely by definition, the RSI, or sorry, the price will be gaining across that period. So therefore, the RSI will be consistently pushing above 50, and furthermore, consistently more than likely pushing above 70. So you can get extended periods of time where the RSI is actually above 70, and therefore, just using 70 as an extreme scenario is not really going to work in a strongly trending market, because it can, as I said, spend consistent periods of time above 70 before retracing that move. So you generally, I would believe in that scenario, you'd be looking to use, I mean, I'm quite a cautious trader anyway, and I would generally look to use look for buy signals in an uptrend, and I'd look for sell signals in a downtrend. I don't like to trade against the trend, so therefore I'd be looking to trade into the corrections, and therefore the corrections you'd be looking at your signals, your buy signals, maybe between 40 and 50 on the RSI, and also then you'd be rising between 50 and 70 on the RSI. You're staying in that trade because it still shows upside potential, and then pushing above 70 again. Now you then start to think about, well, maybe if you're extremely you're seeing an extreme move above 70, how do I take how do I start looking for the profit trigger? Well, as I'll show you in a little bit, you can start to think about taking profits on a couple of signals, such as crossovers and divergences. But once again, I would not recommend being short on those signals. I just think that they would be more likely you'd more likely benefit from them being profit triggers rather than sell signals in a strong uptrend. Similarly, in a downtrend, you've got the opposite, basically, where the market is spending consistent times in decline. Therefore, the RSI is generally below 50. And looking to push into oversold territory, which is below 30. And again, it can stay below 30 for a considerable period of time. Once again, you're looking for your sell signals in a downtrend, because buying into a downtrend, I think, is a risky strategy. So you're looking for your sell signals maybe between 50 and 60 on the RSI, and once again, you are consistently in that trend. When the RSI is falling between 50 and 30, you've got further downside potential, so you stay in that trade, and then you start to think about your profit triggers when you move below 30. Sorry, your profit triggers on your short position on your moves below 30. So tips for, let me just show you thinking about it. Here we go. Why not show you the trend? Here we go. This is dollar yen over the course of 6-8 months between November 2012 and May 2013. So that's 6 months. And you see this consistent trending higher market, and look at the RSI consistently above 50. I've got a line in here at 48, but you can see that it's spent over a month above 70 here. So consistently above 70, you then start to look at your dips as your buys. So every time you dip, you come back towards that 50 point, or maybe even 40 here, you're still looking at buying. So here again, you're below around 50, you're buying. And then once you start to break down that trend, you get a gauge of how that is moving. I think when your RSI starts to fall below 40, you start to break that trend that you've been moving higher in. So you start to think, well, maybe this relationship is breaking down, and maybe it's no longer a useful strategy. So you then look at, went one too soon. Tips for a ranging market. Okay, so this is the second type of market you can use your RSI in, which is a range-bound market, which is where the prices are generally moving sideways. And in a sideways trading market, you generally tend to find the RSI spending a lot of time just oscillating between 35 to 65. You might see a peak, you might see a little dip towards 30 or a peak towards 70, but generally these are seen as extreme moves, and you'd certainly be looking, I think, in a sideways trending market. This is the time at which I think is the easiest time to use the RSI in a sideways trading market, because you just basically look for your buy signals between around 30, maybe 35, and your sell signals up around 65 to 70. Nice and easy. So show that in practice. Again, dollar yen over the last 6 months, 8 months of this year, you've had a sideways trading market. Dollar yen's gone nowhere. And what can you see? You can see the RSI just moving nice and serenely between overbought and oversold. You could argue between 35 and 65. Every time you get towards maybe 35.40, you're starting to think about your long positions. And then every time you get back towards 65 to 70, your short positions. Now, when does this relationship break down? I believe that now the move that we've seen in the last month or so, last 2 weeks, sorry, I think that means this breakout here where the RSI has gone extremely high, 78, I think it hit. Let me just see. Yeah, 78, which was the highest it's been for Lord knows how long. And I think that suggests now that the RSI is moving out of, the dollar yen is moving out of this sideways trending market, and it could now be looking to form a new trending market to the upside. I think the bulls are trying to gain control, and therefore, subsequently, I don't think you can now use this sideways trending market RSI strategy as something that you should be trading with. So that is the two different markets that you use the RSI on. Okay, so what are your different trading signals then? Well, you've got quite, as I said, you've got three. You've got crossovers, you've got divergences, and you've got failure swings. Now, crossovers. I believe crossovers work best in a ranging market, similar to what I just told you about dollar yen. Any sort of move back towards 70, I think, again, is your sell signal, and anything towards 30 or below, I think, is your buy signal. And that's basically because in a trending market, you can stay above 70 and below 30 for a sustained period of time. But once you then cross back below 70 on your strong uptrend, I think that if again, depending on the market you're in, if you're then given a sell signal which is across below 70, having been above 70 on your bearish crossover, that gives you a sell signal that I think you can use. I think in a market that's not a strongly trending market, I think you can use your sell signal where you have your basic bearish crossover. Similarly, you've got a bullish crossover, as in with this chart we've got here depicted, where you've seen the RSI move below 30 and then cross back above 30. I think that is it's a basic signal, but it certainly is a signal. Now, I think what you need to bear in mind is, as with pretty much everything in technical analysis, and I will stress this, trading in isolation is a very risky strategy. You should, otherwise you will, I think, not have the confirmation of such a definitive idea of your strategy. I think you need to be looking for different trading signals across different indicators, all coming together at the same time. That can add to your conviction in your trade, and I think that therefore you can be a lot more confident in your move. Now, trading in isolation is a risky strategy, so you'd be looking for other signals other than the RSI crossovers, but still it is a signal, and it's something that you need to be aware of. Now, this is your bearish and your bullish crossover. moving on to your bullish and bearish divergences. Now, this is an extension, I suppose, of this crossover strategy, because you get your divergences where you've got higher. Say, for example, we're starting with bearish divergence, where the price peaks at a higher level, but the RSI doesn't. The RSI peaks at a lower level. Now, if you just think about the concept of throwing a ball into the air when the price, when the ball is still moving higher, but the velocity of the move higher is slowing down as it reaches the peak. And that is the same sort of concept with momentum, and certainly with divergences, where the momentum indicator can start to fall whilst the price is still rising, and that is where you get your bearish divergences, where you get your RSI peaking at a lower level to your price. Now, theoretically, your sell signal on this, I believe the best divergences come where both signals are above 70 on the RSI, but a lot of textbooks you see and a lot of other websites you might read will not necessarily focus on that, but I think it works best when the second peak is also above 70 on the RSI. Your sell signal comes when you basically see that second peak forming, and the price starts to fall, and the RSI starts to fall. So that's when you get your sell signal. Equally, you've got your bullish divergence. Same sort of concept, where the price is still falling, seeing a lower low, but you see a higher low on the RSI. Now that just suggests a loss of downside momentum in the price, and that the fact that the price is getting ready to form some sort of a reversal. Now, in my opinion, there are confirmations of bullish and bearish divergences, and a lot of people would like to wait for these confirmations. And you get the confirmations through your failure swing. A failure swing is the third signal you get through the RSI. It is in isolation. It is nothing to do with the price. It is just the RSI on its own, and it's basically where you see your lower peak. This is on the bearish failure swing. You see a lower peak in the price. Again, I would rather see your lower peak above 70, but again, that's just in my opinion. And you get the failure swing is where you cross back below the initial low. So you've got your initial low here on this 10 line, and then you've seen a cross back below that low. So that is your failure swing. That is your sell signal. Because you can get, as I said earlier, you can get your initial sell signal on your bearish divergence on your RSI up where you get your lower peak. But that lower peak, as you can actually see in this, might be a false signal. So you get your confirmation of that lower peak when you actually move below the first reaction low on that RSI, and that is a failure swing. And I believe that is it's a very good signal. And basically, the best signals you can get in the RSI is a bearish divergence or bullish divergence with a failure swing. Your bullish divergence failure swing, your bullish failure swing is exactly the opposite, where you've got a second higher low, and then you move above that reaction high in the RSI. As I said, that is a very strong signal, and I'll show you several instances now of how that does. Okay, so here we go. In practice, this is euro dollar. October 2013, where euro dollar went above 70, you've got a very nice crossover sell signal, bearish crossover, where RSI fell below 70, and let me get my crosshair on here. You actually got your sell signal before the price really started to move lower. So that's a positive move. On the downside, it's a nice sell signal, and that worked very successfully ultimately. Equally, you've got the Aussie dollar here in April 2014, so not too long ago. Aussie dollar went above 70 and started to closed back below 70, and that coincided with the price falling away. Now, again here, this is an instance where it could well be that you're in a nice strong trend, 3 months of a nice uptrending move here on the Aussie dollar. You want to move above 70, and is that a sell signal or is it profit trigger? Because presumably you would have been hopefully in this trend higher. Now, to trade against that trend is again a risky strategy. You would have been able to play it out for a short period of time here throughout April into early May, and maybe you play it until the RSI gets back to 50, because again I think it depends on what trending market you're in, whether you're in an uptrend or you're in a sideways trend. Because here, this instance, what we've got is the sell signal, but that sell signal is coming with an uptrend, so it sort of means that you need to be a little bit careful as to how you play that sell signal, whether you just use it as a profit trigger and then wait for the RSI to come back towards 50, or use it as a very near-term trading sell signal, and you close out that short position around that 50 mark. It's just a couple of ways of playing it. Okay, so here we've got a bullish signal. This is on the dollar CAD recently, July 2014. We've had our move below 30 on the RSI, and then you cross back above 30, and you start to see the RSI recovering very strongly, and that was an excellent trading signal, to be honest. Very strong signal. Once again, I mean, I'll zoom out here just to show you what sort of trend you're in. Well, you could argue that you're in a near-term downtrend. That's a 3-month downtrend. You've seen a buy signal within that, so maybe you then start to think, okay, well, it's only a short-term signal. Maybe back towards 50 is where we start to think about coming out again. In the event you actually got the dollar CAD moving back above 70, and arguably then giving you another sell signal back here, January 2014, just because I zoomed out, here is another sell signal that you've got on your dollar CAD. So a nice move lower there, and then subsequently you've been in this strong trending move higher. Again, opens the debate whether you should be trading against that trend, because ultimately you started to move higher again. Maybe you just use that as your near-term sell signal, or and maybe come out back when the RSI falls back below 50. Or you just simply use it as your profit trigger, and then you start to think about going long again once the RSI dips below 50. So as I said, again, there are two different ways of doing it, once again, on this dollar CAD. Now, the S&P 500, this is actually quite a long time ago, but still, I think it shows you a nice bullish divergence, with the price falling to a lower low, RSI peaking at a higher low, troughing at a higher low. You've also got a failure swing, which is nice, because you start, that was the reaction high, 43.9, and then you started to move above there, and that's your failure swing, so you've got your buy signal. Additionally, you can also use, which is something that I haven't really touched upon yet, but something that you can use, is that you can use the RSI once your RSI does still use the concept of support and resistance to a certain extent, and you will see that periods or occasions where the RSI comes back towards a level, say for example here, the RSI was used as the basis of support on several occasions through June and July, this breakout, and that became a level of support. And you could even argue that also up here you gained a level of resistance as well. So you could even argue that you could have taken advantage of this little effectively sideways trending scenario here in the RSI. GBP. Here is a bearish divergence with a failure swing. You see your higher highs, but lower highs on the RSI, failure swing, bang. Again, the argument being, what sort of market are you in? Are you in a trending market? Are you in a sideways trading market, sideways ranging market? Well, you would argue, I think, that having been moving higher for 3 months and also breaking up above all this resistance, I think you then start to think, well, maybe we're in a trending market, so maybe this signal here is probably going to be a near-term signal. It's only going to be either a profit trigger or a very near-term short position. And ultimately, what happens? Well, you get your RSI that comes back towards 50, and you start to form support again. So yeah, you would certainly say, I think in this scenario, once you're in this trending environment, I think you start to think, well, okay, I can only trade this one of two ways. I can use it as a profit trigger or as a very, very near-term signal to short, to get the RSI back towards 50 again. Euro yen. Euro yen from, again, a little bit of time ago on Euro yen, back to February, March 2012. Bearish divergence, again with a failure swing. Okay, let me zoom out and see what sort of market we're in here. Well, I would argue that you're getting that. That's actually a very good one, because you've got a downtrend, big downtrend, big long downtrend. You've started to recover, but not in any real sense. It's also coming out, sorry, I'm just bringing in a bit more technical analysis here, but you're also coming in at these peaks are coming around about these resistance areas. So you then got a bearish divergence with a failure swing on just a minor rebound within this big trend. And I would then say, okay, well, that is subsequently going to be a big sell signal. That's a good shorting opportunity. You've got your failure swing there, and subsequently you get a lot of downside. So I will stress this once more. I know you're probably getting bored now, but just bear in mind exactly the market you're trading in, because the RSI and the signals you get from the RSI, whether you're looking at medium to longer term trading signals or very near term trading signals, just because you need to know exactly what sort of trend you're in, whether it's a sideways trend or a big uptrend or a big downtrend. Okay, just very quickly, does it work on intraday basis? Yes, I believe it does, and I've got several signals here just over the past few weeks actually. Start with this. This is where we start to get a bullish divergence. Sorry, my mistake. Bullish divergence on the RSI. You get a failure swing, and then bang, you're up to the upside. Then you trade around. Not really any major signals here. You could argue that we're starting to think about RSI getting a bit stretched to the downside. Moves back to the upside. You've got a strong period here of actually upside, but you're basically just back to these resistance levels here. So then when you get this crossover sell signal, you think, okay, well, there maybe is something in this. So what happens subsequently, you get a sharp move to the downside. That sharp move to the downside, you start to get a recovery in the RSI, which subsequently turns out to be a bullish divergence with a failure swing. And then you can start to think about long positions again. So you then move along. RSI goes above 70, you get a crossover. It's not the best in the world. It isn't the best in the world, but subsequently it does actually end up working, but it's not the best one. Here again, you've had a sharp move to the downside. It's a crossover, so I stress again on, I think it's a base. I think the crossovers are a basic trading signal. My favourite signals on the RSI are bearish divergences, bullish divergences, and certainly backed up with a failure swing. But your crossover signals are still relevant. Okay, just a couple of comments from Hassan. But there are so many signals. Okay. What is it at the 2nd of July? Well, exactly. This is my point being that you do get. I'm presuming you mean, is that a crossover there? Well, this is my point. The fact that you get, I think crossovers are a very basic trading signal on the RSI, and it's not a signal that fills me with much confidence unless you're looking at an extreme move on the RSI. I think it's followed by a crossover, and I think this scenario here, where we've got an extreme move up towards 80, you're actually over 80. Sorry, you're over 70 for almost a couple of days there, and then you get the signal. I think that would suggest, and subsequently here, this move here, where on the 23rd, where you just slightly moved above 70 and then just came back down, I think that would give me a little bit of trepidation. I'd be a little bit concerned about trading that, because it's a little bit of a weak signal. I think I like to see signals that are definitive, I think, and just absolutely staring you in the face. And I think that this one here, this crossover here, to be honest, it almost sort of passed me by. The fact that it's not really doing a great deal. You could argue your mindset in that scenario would be, okay, well, I'm starting to think about maybe profit triggers and shorting. I think that would probably be more the case of what you're thinking in that scenario, rather than, oh my God, the RSI has gone above 70. It's just briefly, just for a couple of hours, gone above 70 and then back below. Is that a trading signal? Well, I think you'd just be a little bit more cautious than that. I think you need to be, certainly in this scenario anyway, but I just think that anything that just moves decisively above 70 and then gets your signal is far more of a proper signal. And I mean that because look at this divergence here, this bullish divergence, where it went back towards 10, peaked above 30, back towards just under 20, and then back again. So that would give me far more confidence to trade that than just a very minor blip, effectively. Okay, so what I'm going to do now is very quickly run through what my views are on markets generally. Euro dollar. This is bringing in stochastics, MACD, moving averages, support, resistance, the whole shebang. Or certainly what my take on markets are. There are obviously thousands of technical indicators, but these are the main ones that I use. On the euro dollar, well, it is still, I think, in this bearish phase. I think that the trading day today has confirmed that. If you went into, say, for example, the hourly chart, you'll see here that euro dollar, there's big resistance around that 32.10 to 32.20 area. I think that remains in big resistance. You could well find that this turns out to be a bit of a base pattern over the past few days, but certainly I think at the moment the bulls are not ready to buy into the euro dollar. If they were ready to buy into euro dollar, they would have done it today, and they haven't done that. And it looks like, once again, a bit of selling pressure. Look at how bearish these indicators are. RSI well below 30. I went through, I'm going to hold my hand up here, I did go through a couple of weeks ago thinking that this was a bullish divergence, as the RSI was seeing higher lows. The price was going nowhere. But ultimately, the bearishness got hold of it again, and euro dollar fell away, and it looks pretty poor once again. You look at euro dollar across several months really. You've got this big head and shoulders top pattern, bang. That gives you a downside move of $1.30. Certainly that $1.31 September low looks under threat, but I think $1.30 is certainly within the realms of possibility. That head and shoulders top pattern there is pretty bearish. Look at all these moving averages. Absolutely just
bearish across the board. It doesn't necessarily mean we're not going to get technical rebound, and ultimately I think any sort of technical rebound would be a chance to sell. You'd be looking out for certainly, I think, rebound towards maybe 33.30 seems to be a fairly decent level of resistance. That 21-day moving average, I think, is a fairly decent gauge as well now, so that's what you'd be looking at. Cable. Wow, again, cable's so bearish. You've just had this uptrend that completely destroyed. Your moving averages are now coming together. Look at them all coming together. They're beginning to all turn lower, bearish sequence, and you're going to get, if that continues, you're going to get in middle of September a big series of death crosses going on if this continues. But it certainly looks like cable is stuck under this big 6-week downtrend, and any sort of recovery within that downtrend, I think it's a chance to sell. You've got a series of resistance levels: 66.50, 67. It's just, look at how big that resistance at 67 is now. These two lows formed tried to form a low there, and then just bang went. So 67 is a massive overhead resistance now. Big overhead supply. MACD lines negative, deeply negative. RSI negative. It just looks pretty bearish. And yeah, stochastics also. So across the board, cable is looking pretty bearish, and you'd be looking for any sort of rebound as a chance to sell cable. Dollar yen is a different ball game. As I said in my webinar just now, it had been trading sideways. It's broken out above that 103 mark. It's broken out even above 104 figure, which was a big resistance as well. When I see this 103 support now as where this correction could be coming back to. Look at this RSI. Again, I will stress, because as I was saying earlier, I think the RSI moving it to 78 has just changed the ball game slightly. I think it gives you, you could argue that if it moves back below 70, which it did on an intraday basis today, but if it closes back below 70, you could argue that's a profit trigger. That's fine. I would not be shorting dollar yen now. I'd be looking for buy signals, and I think the buy signal is going to come around 103 to 103.50 ultimately. And I think that is a sort of level that I'd be looking at getting long on dollar yen. Look at these moving averages all turning up in bullish sequence. Momentum indicators also turning more positive as well, so that is good. Okay, I've had there's a request for euro sterling. No problemo. Euro sterling. Here we go. Now again, why? Let's see. We'll do that again. EUR GBP equals. There you go. Right. Now, euro sterling. What are we looking at? Well, it's a mixed bag actually, I think, because you had this base pattern that was completed, head and shoulders reversal, that actually gives you a target of 81. But ultimately 81 is still just a blip effectively within that big long downtrend. And it would just give you another chance to sell. I think it's a near-term signal. And anything in terms of a rebound, I think is a chance to sell on euro sterling. Big resistance now at 80.30, and certainly the failure of that neckline gives me a little bit of concern near term, because I had certainly been thinking that maybe we're going to get a recovery. But if you look at the momentum indicators, once again, RSI has fallen over at 60. That's not a good signal. MACD lines, here we go, sell signal. And stochastics also falling away as well. So not really that positive at all. Certainly, I think if you lost that support low at 79.20, I think that would be your renewed sell signal. I think that would just give you more of a concern that we're going to certainly retest that low at 78.66 that we saw in July. I think the pressure is certainly on the euro. I mean, just taking a step back and look at that big bearish trend that we've got in euro sterling is not really going anywhere. You could argue that maybe there is something going on in terms of as I said, a rebound still, but that resistance at 80.30 is just capping the gains, and I'm certainly concerned that the RSI fell over at 60, and you've now seemingly you're on this more of a corrective angle. Yeah, I'm not all that hopeful anymore. I was, as I said, thinking that euro sterling had the potential to recover, but it now looks like it's fallen over, and it doesn't look positive at all. Okay, so here we go. I'll take some questions then, if that is the case. Right, here we go. Okay, how do you handle economic data releases and news? Well, when you say how do you handle, I do take a look at economic data. Certainly, I think if you're a near-term trader, you need to be well on top of economic data. Longer term, not so much. Near-term trading is massively influenced by economic data. You need to be right on top of it. You need to have maybe squawks going on. You need to make sure that you are looking at your RNS statements and things like that. So it's just for if you're a near-term trader, it is a big problem that you need to be on top of. My favourite time frame to trade, I think, I'm more of a. I mean, I use the intraday hourly charts and I use the daily charts. I don't really find going much beyond hourly in terms of downwards towards like 10-minute, 5-minute charts. If you're trading across a range of a few days to maybe a couple of weeks, I think it's not really going to help you. I think I like my main chart analysis comes on my daily charts, and then I back that up with my hourly charts because that's my time frame in terms of I trade from a couple of days, maybe 3-4 days, towards maybe a couple of weeks. Do you recommend 4 hourly charts? I'm presuming that is for RSI signals. Well, again, that would be between hourly and daily. So I don't personally look at 4 hourly charts, but yes, there is certainly going to be some sort of benefit for doing that, and it's just something that I've done. I use hourly and daily, but yes, certainly 4-hour charts are certainly something you can look at. I had a request for Brent. Okay. I'm rubbish at my Brent code, so bear with me. Very briefly, LLCOC1. Sorry, hold on. LCO. I don't Brent. LCOC1. Being stupid. It's such a horrifically messy chart, isn't it? It really is. I mean, I don't know what that's doing there. Just generally, just really messy. Not gone anywhere. You would argue that maybe trading and using the RSI is an idea, but it's so messy. It's such a horrid chart to analyse, just generally. I mean, I think you just have to think, well, okay, Brent is trading generally between 100, I know this is so basic, but up towards 100 and got your basic sideways trending scenario going on there. Moving averages basically doing nothing. The only reason they've fallen lower is because we're back towards the lows of the trading range. In a sideways trading market, moving averages become basically redundant. So you then look towards maybe your RSI giving you signals and the stochastics giving you signals. They've both turned up recently. So maybe you're starting to think, well, maybe there's going to be a bit of support coming in. You're back towards the lows of the range. Zooming in, back towards the lows of the range. You then start to think, well, if you break your downtrend, which you're not a million miles away from doing, to be honest. I mean, it's a pretty messy downtrend, but still a downtrend it is. If you start to break that downtrend and also trade above that 21-day moving average, I think you start to think, well, maybe there is something in this turnaround. You could argue that's a bullish divergence, but it's not great. Maybe you'd still play the range back towards from anything around in the low hundreds towards 108 seems to be a level. 107, 108 seems to be a level where it consistently comes back to, but Brent crude is a big nightmare in terms of my opinion. Okay, so right. So I hope you've enjoyed today, and basically we do run technical analysis webinars at Hantech, and the next one is on stochastics, and you're free to join that if you go to your browser and hantechfx.com/webinars. You can get more information there. You've also got, if you can sign up to my daily research. I do morning reports, I do analysis videos, I do weekly strategy reports, I do intraday reports as well, and I do a lot of comments on Twitter. So at HantechRich is my Twitter handle. So there's a lot going on that you can find information about. Any feedback as well is marketing@hantechfx.com is our email address. Now, in terms of what Hantech does, we're a London-based UK regulated broker, and we specialise in forex, bullion, CFD trading, and we actually have retail and institutional traders worldwide that we have as clients. So there's a lot going on. We operate 100% automated no dealing desk model with and we actually have competitive spreads on MT4, CurrentX trading platforms. You can actually have a trial on those trading platforms free of charge for 30 days as well with our demo account, and you can have more details of that on our website at www.hantechfx.com. And yes, so pretty much I believe that is it. Again, that is my disclaimer for you, so you need to just have a quick read of that and just be careful of it. Anyway, so I wish you good luck in all your trading this week. Thank you for your questions. Again, if I haven't answered any of your questions, please don't worry about emailing me. I will get back to you and give you more information as to hopefully RSI or whatever trading you're interested in. If you want to talk about anything else trading wise, then give me a shout. No problem whatsoever. I'm here to help. So I wish you good luck in everything you do in your trading and everything really. So I will speak to you next time. Thank you very much. Bye bye.